Biotech's 2020 to 2022 boom was one of the most extreme in the sector's history, and what came after was anything but a routine pullback. Three forces defined that expansion: a surge in IPOs, a flood of speculative capital, and rapid hiring, all built on the assumption that cheap liquidity would last forever. When rates rose, the dominoes fell fast. Public markets closed to weaker issuers, early IPO cohorts lost enormous value, and a wave of bankruptcies swept through the sector. The capital reset rippled outward, triggering real layoffs, pushing hiring toward execution-focused roles, and shrinking the number of publicly listed companies as insolvencies mounted. What the new environment rewards is clear: disciplined execution, rigorous data, and the ability to resist getting swept up in narrative momentum. But before declaring a recovery, it's worth pausing on the risks that could still derail biotech's fragile stabilization. Four threats loom. A premature IPO reopening could let weak issuers back in. FDA policy uncertainty remains unresolved. Late clinical failures could still crack fragile balance sheets, and overleaning on AI risks hollowing out the depth of scientific discovery. One of the most compelling questions hanging over the sector right now is what happens to Moderna and to mRNA once the pandemic trade is fully in the rearview mirror. Moderna built its identity as a pandemic platform leader, but the harder question is whether that head start can translate into a durable, multi-product franchise as mRNA expands well beyond vaccines. The Biotech Capital Compass is designed for exactly this kind of analysis, offering data-driven, structured insight for investors and curious readers alike, sharpened by an engaged community that stress tests every assumption. That work is anchored by Hartaj Singh, who brings over 30 years across drug development, corporate strategy, hedge fund investing, and biotech equity research to the analytical frameworks here. Now let's dig into the first major lens: the 2020-2021 IPO boom, and how a period of capital abundance fundamentally distorted how biotech behaved. Before 2020, biotech financing was actually in a healthy place. IPOs were frequent but disciplined, companies were clinically mature, and capital roughly kept pace with scientific progress. Then, three forces converged: near-zero rates, massive monetary stimulus, and the urgency of COVID-19, together drawing a wave of generalist investors who reframed biotech as strategically essential, not just high risk. IPO proceeds jumped from roughly $16 billion in 2020 to over $20 billion in 2021, an all-time high for the sector and a sign of just how fast the floodgates had opened. Historically, companies needed phase 2 human data before going public. But in 2020 and 2021, that bar eroded, with a significant share of IPOs coming from preclinical companies, pulling private-stage risk straight into public portfolios. Valuation inflation was driven by a combination of forces: SPACs offering less rigorous paths to market, early-stage listings with thin clinical data, and high burn rates, all creating an ecosystem that depended on continuous follow-on capital to survive. As long as capital was cheap, this fragility remained hidden. Then 2022 arrived. Inflation surged, the Fed tightened, rising discount rates crushed the long-duration value of biotech assets, and broad benchmarks fell sharply as generalist investors were the first to leave. For early-stage companies with limited data and high burn rates, the consequences were immediate. The IPO window shut, follow-on financing dried up, and valuation support simply vanished. By early 2025, the numbers told a stark story. Companies that went public in 2020 or 2021 were trading more than 40% below their offer prices, with fewer than 1 in 5 holding a positive return. The market had priced speed and scale ahead of validation, and biology eventually pushed back, making clear that capital cannot substitute for clinical proof. The years that followed were defined by retrenchment, a funding winter where capital discipline reasserted itself and the bar to access public markets rose dramatically. The contrast between eras is striking. Where boom-era IPOs required almost no clinical maturity, By 2023, every successful listing featured clinical stage assets, and many had phase 3 programs already underway. By 2024, the market had become ruthlessly selective. Capital concentrated only in companies with late-stage data, clear regulatory paths, and strong institutional backing, with even modest clinical setbacks triggering sharp declines. Now let's turn to the second lens, the insolvency wave, which offers the clearest evidence that this correction went far deeper than valuation compression alone. Where bankruptcies once numbered in the single digits annually through the 2010s, 2023 and 2024 saw failures reach their highest level in over a decade. And they were no longer confined to tiny firms, with mid-cap biotechs carrying hundreds of millions in liabilities now among the casualties. 3 forces converged to push companies over the edge: missed clinical milestones that blocked market reaccess, the collapse of Silicon Valley Bank, which disrupted venture debt and credit across life sciences, and capital markets that had simply closed. In 2025, 3 external shocks kept the pressure on. Proposed federal science budget cuts created grant uncertainty. Trade policy volatility rattled investor confidence, and government shutdowns delayed the regulatory approvals that cash-constrained companies desperately needed. Cell therapy's fall was one of the starkest stories of the period. Once the crown jewel of pandemic-era investment, it peaked, then watched capital withdraw, major pharma partners walk away from multi-billion-dollar deals, and a cascade of closures follow. Insolvency rarely had a single cause. It was usually a convergence of scientific failure with no follow-on funding to pivot, operational miscalculation about refinancing access, and legal or IP risks that tipped already weakened companies into bankruptcy. The M&A landscape told a tale of 2 worlds. Dozens of biotechs failed or sold at cash value, while a small number in the right therapeutic areas commanded extraordinary premiums, making clear that upside still existed but had become exceptional rather than assumed. By 2026, a new operating model is taking shape, one where capital efficiency has replaced expansion as the core imperative, and companies are narrowing their pipelines to focus resources on 1 or 2 lead assets. The contrast with the pandemic era is sharp. Where broad platform building once defined ambition, the 2026 model is about pipeline discipline, concentrated resources, and layoffs used as tools of strategic refocus rather than simple cost-cutting. The third lens is labor, a market that mirrored the capital cycle almost exactly, expanding fast in 2020 and 2021 before undergoing a painful and structural reset. On the surface, biotech hiring looked strong during 2020 and 2021, but beneath it, revenue and profitability were concentrated in a handful of pandemic winners, and many companies were hiring ahead of clinical validation, assuming markets would stay forgiving. When capital costs rose in 2022, the chain reaction was swift. IPOs collapsed, follow-on financing evaporated, companies pivoted from growth to survival, and by 2023, layoffs had become a defining feature of the sector. The reasons for cutting differed sharply by size. Small-cap biotechs were laying off to survive, while big pharma restructured proactively to concentrate on fewer high-conviction products, creating the paradox of layoffs at financially healthy firms alongside insolvencies at formerly cash-rich ones. By 2024 and 2025, workforce reductions had spread beyond R&D into administrative, HR, and support functions. A clear signal this was structural consolidation, not just cyclical noise. Hiring didn't disappear. It polarized, with demand concentrating in metabolic disease, radiopharmaceuticals, and next-generation oncology like antibody-drug conjugates, while manufacturing, regulatory, and analytics roles held up far better than discovery science. Geographically, the long-dominant Big 3 biotech hubs faced excess lab space and slower hiring, while mid-tier U.S. cities and Asia-Pacific centers gained ground, driven by lower costs, targeted infrastructure, and supportive policy. The 2026 biotech workforce looks fundamentally different, smaller and more specialized, with deep biological expertise now expected to sit alongside data science fluency and regulatory literacy as core competencies. The 2020 to 2025 period will be remembered as one of biotech's most extreme boom and bust cycles. So what does the sector actually look like on the other side? Pandemic exuberance left three structural distortions in its wake: platforms overcapitalized without clinical grounding, clinical programs that were underdeveloped, and a workforce that expanded far beyond what the data could justify. The gap between 2021 and 2026 biotech is stark. Where abundant capital once funded speculative platforms and broad hiring, today's ecosystem rewards clarity, late-stage proof, and fluency in AI, manufacturing, and regulatory execution. The result is a barbell market. On one end, a cleared field of failed speculation. On the other, a leaner cohort of resilient companies that survived the correction and now define what biotech looks like going forward. The recovery ahead is unlikely to resemble 2021. Instead, it points to a slower, more demanding, but ultimately sustainable era of biotechnology innovation.